What if a fee you've never seen on any statement is quietly taking a third of your retirement? A typical Canadian mutual fund charges about 2% a year, and on a $180,000 RRSP that's roughly $3,600 gone annually, money you never see leave your account. Over a working lifetime, that quiet skim can erase more than $150,000 from your nest egg. This affects millions of Canadians because we pay among the highest fund fees in the developed world. I read the fine print so you don't have to. Today we're going to do 3 things: audit your fees, benchmark them against index ETFs, and use new disclosure rules to cut them, all in under 30 minutes. Here's the central number, 2%. That's the typical management expense ratio, or MER, on a Canadian equity mutual fund, according to Retire Smarter's 2026 analysis and Wealth North 2026. Compare that to about 0.25% for a broad index ETF, but here's the part nobody tells you. That gap decides most of your long-term returns. 3 moves. First, audit your MERs and the dollars they cost. Second, benchmark them against ETF averages. Third, use fee disclosure to cut your costs. Each takes under 30 minutes and every tool's free. So what exactly is this MER? The management expense ratio is the bundled annual cost of owning a fund, expressed as a percentage of the fund's assets, and it's paid out of the fund, not billed to you. It's deducted daily from the fund's net asset value, so the return you see is already after fees, and no dollar figure ever appears on your statement under current rules. Now the impact. The average Canadian MER hovers around 1.98%, which means for every $100,000 invested, you pay roughly $2,000 every year, Fool.ca 2022. A broad index ETF charging 0.258% would cost about $250 on that same $100,000. Retire Smarter 2026. That's not a rounding error, it's the difference between funding your retirement and funding someone else's. The second layer is compounding. That MER is charged every year on your entire balance, including all the growth you've built up, Retire Smarter 2026. And a big chunk of it is embedded trailer commissions paid to advisors for selling you the fund, which the OSC's investor site confirms are included in the MER, not broken out separately. So what's the cost of doing nothing? Wealth North calculates that on a $100,000 portfolio over 20 years, EURCI 2.10% MER versus a roughly 0.24% ETF costs about $92,000 in lost growth, Wealth North 2026. Stay put for a full career, and as Retire Smarter shows, the fee compounds into 6-figure, roughly a third of your eventual pot gone. Here's the belief that stops people acting, that 2% is the fair price of expert management that beats the market. But multiple analyses show there's no compelling evidence that paying 2% for broad equity funds beats a 0.20% index ETF, Retire Smarter 2026. That fee mostly pays trailer commissions and overhead, not outperformance. Put both costs side by side on $100,000, so a 2% MER skims about $2,000 every single year, Fool.ca 2022. And over 20 years, that fee gap costs about $92,000 in lost growth, Wealth North 2026. A small percentage, a staggering total, because it compounds on your whole balance. Let me make this real. Meet Sarah. She's 42, a marketing manager in Toronto earning $95,000 a year. She has $180,000 invested, a workplace RRSP and a personal TFSA, both held in big bank mutual funds, and she's aiming to retire at 65. Here's what Sarah found when she finally looked. Discovery 1, about $3,600 a year, gone. Sarah learned the average Canadian MER runs near 1.98%, Fool.ca 2022, and at roughly 2% on her $180,000, that's about $3,600 annually. Using the 0.32% asset-weighted ETF average, she'd pay closer to $576 Belvest 2026, saving over $3,000 a year she never knew she was spending. Discovery 2 hit harder, scaling Wealth North's $92,000 over 20 years example to her. $180,000 balance over 23 years, the fee drag lands comfortably north of $150,000 in lost growth. Author's estimate anchored to Wealth North 2026. She'd thought 2% was a minor cost for professional management. In reality, it's on track to remove about a third of her nest egg. Before I get to what she found third, which is the most counterintuitive part of all this, remember the fee is invisible, so she'd assumed she was paying for skill. Discovery 3. Most of it isn't for performance at all. Her MER bundles trailer commissions, taxes, and overhead, and she's paying over 6 times the 0.32% ETF average, Belvest 2026, for exposure she could get for a fraction of the cost. Add it all up for Sarah, over her remaining 23 years staying in burst 2% mutual funds instead of switching to 0.25% index ETFs could cost roughly $150,000 in lost retirement wealth, author's estimate. That's modeled at a 7% gross return, anchored to Retire Smarter, Wealth North, and My Wealth App's published examples. So could this be you? Sign 1. You've never seen an actual dollar fee figure on your fund statement. Sign 2. You couldn't name the MER on a single fund you own. Sign 3. You bought your funds through a bank branch or an advisor. If any of those ring true, the next 3 moves are for you. Now let's fix it. And these moves matter because the fee compounds silently for decades. So every year you delay costs real money. We're going to find your exact fees, benchmark them against what low-cost investors pay, and use brand new disclosure rules to cut them. None of this requires a finance degree, and all of it is free. Move 1 is to audit your MERs and the dollars they cost. Log into your bank or group RRSP portal and list every mutual fund you own along with its code. Then for each one, open the fund facts page and write down the MER. That's the number that reveals what you're really paying. 3 steps. Log in and list every fund plus its code. Open each fund facts page and note the MER. Then multiply each MER by its share of your portfolio to get your weighted average. What good looks like? Under 0.5% is excellent. Anything over 1% deserves hard scrutiny. Move 2 is to benchmark your fees against ETFs. Take that weighted MER you just calculated and stack it against the industry averages. 0.32% for Canada-listed ETFs versus 1.47% across all mutual funds, according to Belvest 2026. Then flag every single fund charging more than dirt 1%. 3 steps. Note your weighted MER from Move 1. Compare it to the ETF and mutual fund averages. Then flag every holding above, 1% for possible replacement. What good looks like? Core equity exposure at 0.05 to 0.25% through broad index ETFs. Retire Smarter 2026. Move 3, the most powerful, is to use fee disclosure to cut your costs. Review your statements today, where fees only show up as lower returns. Then when the new total cost reporting arrives, you'll finally see the dollar amount of your fund expenses and you can ask your provider for low MER alternatives. 3 steps. Read your statement and note fees show only as lower returns for now. When TCR shows the dollar figure, compare it to the ETF cost. Yon $100,000, that's about $2,000 versus 320 Belvest 2026. Then request low MER index funds for the same mix. If breakdowns like this help, subscribe. The next one's already coming. Why act now? Back with CRM2 reforms, dealers had to disclose some charges, but MERs stayed embedded in returns, invisible as dollar figures. Get smarter about money. Then starting with 2026 statements delivered in early 2027, total cost reporting will require that you finally see the actual dollar amount of your fund expenses. Belvest 2026. And once investors see those numbers, pressure to cut fees will build fast. So fix yours before another decade locks in. Once you've acted, here's how to check it worked. You should see a weighted average MER under stats, 0.5%. Confirm your new holdings charge between 0.05 and 0.25%, not 2%. And if total cost reporting later shows more than $500 per $100,000, it's time to review again. Everything I've cited today, Retire Smarter, Wealth North, Belvest, and the OSC's Get Smarter About Money, is linked below so you can check the numbers yourself. I genuinely encourage you to look up your own funds before you take my word for any of it. So you now know how to find the invisible MER, benchmark it, and cut it. Next, I'm covering the RRSP withdrawal order, the sequence for drawing down your accounts that can save you tens of thousands in tax. That one genuinely surprises people once they see the math, and it pairs directly with everything we covered today. If you want to catch it, subscribe now so you don't miss it.